What's going on, everybody? It's your instructor Mike here. Welcome back for our lecture today, and we're going to be talking about taxes. I might get a little heated here, a little fired up, because I hate taxes, and I know that's a strong word, but I hate taxes, and so should you, my friend. They're junk. They're fraud. So let's think, how many different ways do we get taxed? Put this in orange so it's nice and bright for you. How many different ways do we get taxed? Let's seriously think about it. Let's go over them. I'm going to try to think with you guys here. So, number one, property tax. So that's one. You're paying thousands of dollars a year to the government just for owning property. That's yours. So, number two, you have your income tax. The money that you sold and traded your time for and you went and worked for, yeah, you got to pay the government some of that. So that's federal, okay? That's your federal income tax. But oh, wait, you got to pay the federal government, but you also have to pay income tax to the state government too, by the way. So you're going to pay some income tax there. So they're getting you all over the place. So when you buy things, tax, state tax. So when you buy things, you're getting taxed. Medicare and stuff like that, okay? That's basically a form of taxes, all right? You got to pay into the Medicare system and stuff. Whether you use it or not, it don't matter. You're getting taxed. They're taking some of your money, okay? Because, guys, tax is a financial charge from the government. That's exactly what it is. So, property tax, income federally, income state, state tax to buy things and such, Medicare tax, all financial charges from the government. They're taking a chunk of your money and they've done nothing, and they print the money, okay? So, what is tax? Wake up, please, and understand this, okay? Fraud, okay? Tax is fraud. Did you guys know when tax first came out, it was around 3%? You know what tax is now? It's literally over 20%, okay? Like capital gains tax is 25%. You got to pay a quarter. If you make profit on selling an investment or something, you got to pay a quarter to the government. Bullshit. Okay, for lack of better words, sorry if you don't like my language, plug your ears, but it's bullshit. All right, tax is fraud. You should figure out every way you can to avoid taxes, and we'll talk about that. But for now, let's keep talking about how many times you get taxed over. Because there's more, believe it or not. There's absolutely more. So property, income tax, I don't know, obviously, any business taxes, if you own a rental property, so you have a rental tax, okay, cities will take, tax and stuff on that, they'll take a percentage of it. But here's what's really crazy, okay? I can't really think of too many things right now. Tax it gets my brain going everywhere because it really gets me annoyed with the fact that we just, as a nation, accept that this is okay. But this is where it gets really messed up. Like, think of how many times you're getting taxed. So, like, here, your income tax, you go to work, you collect money, okay, you get paid, you get taxed. They take some of your money. Then you own property, they're going to take some more of your money. Okay, all right, so you got it twice now. Well, the state's going to take some of your income tax too. So, all right, that's third hit. So the money that you already got taxed on when you earned it is going to get taxed again when you buy something that's not a necessity. That's pretty crazy. And you got to, put tax into Medicare and, pay your share of Medicare whether you use it or not because whatever reason. When other countries have free healthcare and stuff like that. But doesn't matter. Business tax, yeah, so after you worked and got taxed and paid money in tax just to live somewhere, and then you invest that money into a business to actually make some more money, they're going to tax you too. So, like, how many times over is the government going to tax you, okay? One day, I hope and pray, it'll probably never happen, but if people could just not be sheep and stand up and say, yo, like, this is jank. Like, look at this right here. 3% to 20% increase from when taxes first started, okay? And remember, taxes came along because they were just supposed to be for war and raising war money. Look where we're at now. okay? Like tax is literally like, it's like mandatory slavery, okay? If you really think about it, it's like mandatory slavery. You're gonna go to work, you're gonna make money, and you're gonna give me some of it, or I'm gonna lock you up. Sound fair? Yeah, not really. You're not as free as you thought. But benefit is there is ways to legally avoid taxes because tax is on your income. All right? So remember we talked about income. Income is the amount of money that you make, that you claim that you made in, profit that goes in your pocket. Well, what happens if you show no income? What happens if you make no income? Okay, when you file your taxes, hey, I made $0. They can't tax you, right? Well, there's ways to make that happen. We'll talk about them. All right, so now that I got a little hot-headed and we established that tax is fraud, let's talk about some ways that we can lower the money that we pay in taxes. So one of the easiest ways for the average person is go to a state with no income tax. Okay, so just move, all right? Move to a different state with no income tax. That'll help you out, number one. Usually when that happens, though, there's higher real estate taxes and such. Do your research, make sure it makes sense. But that's an option. So another option 2 would be a business. Create a business. Why? Well, when you create a business, you get write-offs, okay? You get access to pre-tax dollars. So that means you get to spend the money before it's taxed, and you get to spend the money on business things like growing and operating the business. Whatever money you have left over, that's what gets taxed. So if you spend all the money consistently growing the business, you pay no tax because you have no leftover profit. So 3, how do we lower our taxes? Well, our taxes on income we can lower and offset from buying real estate. Because remember, we spoke during our lecture on interest that real estate mortgage interest is a tax write-off or a tax deductible expense, which means the money that you pay on your mortgage for borrowing that money, the interest you pay each year, you can subtract that from the amount of income that you have, and that will lower the amount of money that you have to pay in taxes. So, if I made $100,000 and I have to pay $8,000 in interest on my home, that means my income is now adjusted to $92,000. So I only have to pay tax on $92,000 instead of $100,000, which is going to save me a couple $100, if not $1,000 or so. So here's a couple ways that we can lower our taxable income, that we can lower the amount of money that we pay in taxes. Because remember, guys, the goal for myself and for you should be to keep as much money in your pocket as possible, okay? You're not able to do that if you are consistently paying taxes, okay? Especially all the taxes that they're trying to hit you with and in full. You can't do that, okay? You need to keep that money in your pocket to invest. So, what do the wealthy do different that most people do not do? Very simple. The wealthy play the tax game, guys. The wealthy play the tax game. They know the benefits. They know the ins and outs. They know the deductions. They know how to lower the amount of money that they have to report that they made to the IRS in order to keep the most amount of money in their pocket so they can keep investing, growing wealth, and gaining more financial freedom. All right, guys, so this is where I want to talk about the goal of the wealthy. My friends, the goal of the wealthy is one thing right here. Here it is. Show no income. Okay? That's the goal of the wealthy, guys, is to show no income. Why? Because income equals tax. The government taxes your income. So the wealthy, they spend as much money as possible investing in things and being able to say that they lost money, that money went out and they have none left over as profit in order to pay no taxes. So say it with me. Show no income, okay? Show no income. That is the goal of the wealthy, all right? If you want to create wealth, your goal is to have no income on paper. Remember, scroll back, okay? Rewind this video to how we talked about how you could possibly lower your income, okay? You need to apply those things if you're going to be creating wealth, because you're going to get there faster by keeping more money in your pocket and allowing you to invest that money instead of sending it to the government that just freaking prints money. So who actually pays tax? Let's go over it. Okay, just by class of wealth. You have the poor, you have the middle class, and you have the rich. All right? So you have poor, middle class, and rich. Well, the poor, they don't pay tax because they have no money, okay? They're not earning much. They don't have anything to give. So, no tax. They don't pay it. The middle class, they go to work every day, okay? Work, remember, is earned income. Earned income, which equals income, which equals what? Say it with me. Tax. Now, the rich, they own the businesses, they own the investments, the assets, all that good stuff, but they don't show any income, okay? So no income, say it with me, what does no income equal? No tax. By show no income, I mean they have no, I'm not even gonna write that down. When I say that the rich show no income, what I mean is when they file their taxes, they're telling the government they didn't make any money because they spent it all already, okay? But they spend it on investments that lower their tax liability, okay? It's not like they're just getting money in and just go buying a bunch of dumb shit and saying, hey, I got no money left over, you can't tax me. No, okay? They're using write-offs, okay, and tax-deductible expenses to help lower their taxable income. So, after we went over this, who pays the tax? The middle class, guys. The middle class. The people that strap their boots up and put their suit and ties on and go to work every day and hustle and actually build this country on their backs. Okay? It's like they're slaves because they're the only ones that are paying tax, all right? You know, the rich, they employ people. You know, the wealthy, they employ people and stuff, but they're not sitting back paying tax because they have access to pre-tax dollars, okay? So that's why I mentioned opening up a business earlier in this video, in this lecture, that opening up a business is a great way to lower your tax liability. So I've been mentioning how the rich report no income, okay? So how do they do that? Through a couple different things, or really just write-offs, okay? So what is a write-off? All right, so very simply, a write-off is just reporting a loss, okay? A loss on paper. So when I say on paper, what I mean is literally like on paper, on the books, on the balance sheet, you know, on the files that record how the business is operating, okay? That record all the numbers, okay? They're just reporting losses to lower the amount of money that they claim that they're making. What that does is it lowers their taxes. So, a write-off is just recording a loss on paper, okay? You do pay for it, okay? You pay for it. So, like, if you run a business and you put $1,000 into marketing, you put that $1,000 out, you spend it, you had it and you spent it, but it's not, you know, income. You know, if you made that $1,000 from the business and then you took it and you reinvested it into marketing, you pushed out and spent $1,000. So you're going to write a loss, okay? So you're going to take that $1,000 and you can minus it from the business income, okay? What it does is it lowers the amount that you have to pay on taxes. It lowers the amount of overall money that you have left over to pay on taxes. But it's not free money. The government's not paying for it. You're still paying for it. It's just by spending that money, you can pay less in taxes and still grow your business, okay? So what is that money called? This is something cool, all right? So that money is called pre-tax dollars. So what are pre-tax dollars, guys? Pre-tax dollars is the money that a company or business spends before it gets taxed. So businesses have access to pre-tax dollars. Employees do not have access to pre-tax dollars. So how does that screw you, okay? Well, I'm going to just show you right now how you can benefit a lot from opening a business and having access to pre-tax dollars. So let's make it very simple, right? Here's a business, and then here's you. Okay, you're an employee. All right, well, the business has pre-tax dollars. Employees don't. So let me show you how this is totally different. We're going to say that the tax rate, super easily, we're going to say that the tax rate's 10%, just because it's going to make it very easy for me to do math here. Now, a business, they get to spend the money before it's taxed. So they made $100,000 in income, right? Well, to operate the business, to run the business, to grow the business, all the money that they're doing to grow this business, they spent $75,000 to grow the business. Well, they did that. It's pre-tax dollars. So they got to spend the money before tax. So whatever's left over gets taxed. So they got to spend that 75 grand on growing the business, paying their employees, paying salaries, doing all these things. So now they really only have 25 grand that they actually have to pay taxes on left over, that they're claiming that they made as profit. That's how pre-tax dollars and write-offs with having a business are going to benefit you immensely. But here's where you really see it. So here's you, and you made 100 grand from a salary. You're not a startup business like over here. You've been working, you got a good job, you're making 100,000. Well, guess what? If it costs you 60 grand to live, you don't get to spend that 60 grand, then pay taxes. No. You have to pay your 10%, and then you get to spend your money. So you got to pay 10 grand, because that's the 10%. So you got to pay 10,000 up front, and then you get to use your money. Then you get to use that 60 grand to live. So now you only have 90 in your pocket, and then you got to spend 60. So really you're left over with $30,000 to invest and to create wealth with. And you paid 10% tax on 100K, because you had to pay the tax first. Where the business, they got to spend the money first and then pay the tax. So their 10% as a business, same amount of money made, just different ways of being taxed. Their 10% is only $2,500 after growing their business, doing everything. Your 10% is $10,000 off the same 100K. That's why having a business, an LLC, and being able to use pre-tax dollars is going to help you immensely. And guess what? It literally takes like an hour to 2 hours, maybe 3, to go set up a business online and completely open up this world to tax write-offs and such, okay? So it's just understanding how to play the game. So how, my friends, do you pay the least amount of taxes? It's very simple. Establish yourself as a business, whatever type of business you want, LLC, C Corp, S Corp, all that stuff. You can do it online. Then you open up this world of access to all these tax benefits, okay? Because the thing is, as an employee, earned income is taxed, you get no tax benefits. You pay tax, then you spend your money. As a business, you get to spend the money and then pay tax. Now, there's a limit on, what you can spend the money on, but I can promise you're probably already buying those things, so you might as well give yourself the opportunity to open up an LLC and get some tax write-offs. Help yourself out, okay? So to wrap things up, for those of you that don't really want to open a business and don't want to be involved in all that stuff, Here's 2 simple ways that you can lower the amount that you pay in taxes if you own real estate. So, number 1 is a 1031 exchange. These are for your rental properties, okay? That's usually what they're for, all right? Rental properties / investment properties. So a 1031 exchange, what you can do is you can defer the taxes. So you can sell an investment property and you can push the taxes back by filing a 1031 exchange and immediately buying another investment property. Usually that's more expensive, that's gonna have better appreciation, better gains, more tax benefits, okay? Usually a better piece of real estate. So you can just keep selling your rentals and buying nicer ones and pushing the taxes back further and further, and you can do it over and over again until eventually, when you're ready to die, you own so much in tax on this house, but you can put it in a trust and it'll be inherited on a step-up basis, which in English words means you can push all these taxes back, open up a trust, put the house in it, and then your kids can get the house when you die for what it's worth that day, and all the taxes that you owed are poof, gone, don't exist anymore. This is complete gold. Make sure you use this if you're ever selling an investment property. And if you say, okay, well, Mike, that would be nice to do, but what if I need to sell that investment property because I need that money? I'll tell you to do it. 1031 exchange, buy another investment property that's worth more, that's nicer, that will go up in value more over time, and then you can refinance, take a loan against that property, and get the money out from the sale completely tax-free while still having a nicer, bigger, better piece of real estate. Booyah! So, option 2, this is for a primary residence, and I believe I addressed this very briefly in one of our other lectures, but capital gains exclusion is for a primary residence that you have lived in for 2 of the last 5 years, okay? So it could be 2 years consecutive. If you bought it, lived in it for 2 years consecutive, you can immediately do a capital gains. Or if you've lived in the house non-consecutively for 2 years in the last 5 years, you can do a capital gains exclusion. So what is a capital gains exclusion? How does it work? Very, very simply. If you lived in this house for 2 of the last 5 years, you can sell the property, and if you make $250,000 in profit, okay, if you make 250 grand or less off selling that property, you can do a capital gains exclusion completely federally tax-free. You're still gonna have state taxes, but you're gonna save a shit ton. You're still gonna have state taxes, but you're gonna save a lot of money, okay? So, tax-free federally, okay? Federally, still take state taxes. Now we said it's up to $250,000. That's per individual. So if you are married, you can do a capital gains exclusion on the sale of your home, your primary home. And if you guys are married, you can have up to $500,000 in profit or make up to $500,000 from selling your house completely federally tax-free. There's still state and local taxes, but you will save yourself tens of thousands of dollars, okay? Tens of thousands of dollars from just these 2 things right here, 1031 exchange and a capital gains exclusion. To wrap this up, tax is fraud. The goal of the wealthy and people that are getting rich and creating wealth is to show no income so they can pay no taxes. Moral of the story, tax is fraud. Don't pay it if you don't got it. I'll see you guys next time.